Let's talk about S Corporation Distribution Rules. And the thing is that if you have an S Corporation, first of all, you need to understand it is not a legal sort of structure. You need to convert your LLC partnership or a C Corporation into an S Corporation from a tax perspective. So let me give you the approach that you need to really have in mind here. So S Corporation shareholder distributions are the earnings by S Corporation that are paid out or passed through. That's the right word here. As they're passed through as dividends to shareholders and only taxed at the shareholder level. So in other words, if you have an S corporation, the first thing you need to remember here is that you're not paying taxes at the company level. So you have a single taxation format here. So you are only paying taxes on your 1040 when you are filing your 1040 Schedule C. Very important to remember that. And so when we talk about let me just give you an overview of S Corporation distributions. I mean, unlike a partnership, an S Corporation is not subject to personal holding company tax or accumulated earnings tax. So when income is earned by an S Corporation, it is taxed only once, regardless of whether the income is distributed or invested. And earnings that accumulate in a retained earnings account are not considered earnings and profits since the income is included on each shareholder's individual tax return, right? Form 1040, Schedule C. And each share of stock gives the shareholder equal rights to retained earnings. This means what? It means the right to the distribution of retained earnings is reflected not by an agreement as it is in a partnership, when you have a partnership, but by the number of shares owned by the stockholder. And if you were to go a little technical here, Section 1368 of the Internal Revenue Code notes that the distribution by an S corporation of property or cash may result in 3 distinct tax consequences to the shareholder receiving the distribution. So you only have 3 options when we talk about S corporation distributions. So first, you have a tax-free reduction of the shareholder's stock basis. You have a taxable dividend, and you have the selling of the stock, which may result in capital gains. Okay, a single distribution may include one or more of the earlier of those 3 potential consequences. Very important. One thing I want to say here is that determining S corporation distributions is basic, but several attributes are required to complete the process, and I will be explaining everything to you in today's conversation. By the way, boss, welcome back to the show. It's really a pleasure to have you here. You are going to have a wonderful conversation with us today. We are going to talk about S corporation distribution rules that you need to be aware of when filing taxes, or even before converting your C corporation or partnership into an S corporation. Let me give you the overview you need to really keep in mind here. Let's first understand the intent of the S Corporation distribution rules. It's important to understand the reasons for different treatment of distributions between S corporations and C corporations. Remember, S corporation and S corporation is not a state affair. A C corporation is. In other words, you incorporate a C corporation at the state level, but you do not incorporate an S corporation. An S corporation is a fiscal arrangement. In other words, you are converting, the conversion happens through the IRS. So a subchapter C is subject to double taxation. The taxable income earned by a C corporation is first taxed at the corporate level. When the income is distributed to its shareholders, it is generally taxed as a dividend. This results in the same income earned by the corporation being taxed twice, right? Double taxation. Once at the entity level and again at the shareholder level. So that's a double taxation C corporation. S corporation, really they are taxed once. So you have single taxation, single level taxation. So income generated by the corporation is typically not taxed at the corporate level. It is distributed among the shareholders and reported on individual tax returns for payment of tax due on their share of the S corporation's earnings. So everything happens through a Schedule K1. So the thing here is that you are not going to pay taxes twice because an S corporation distributes income as a single, let's say single level taxation model. It will not be taxed a second time. And so the purpose of Section 1368 and its regulations is to support the preservation of the differences between a C corporation and an S corporation, specifically the earnings and profits and the single taxation process of an S corporation versus the double taxation process of a C corporation. So good news is that if you are listening to me right now and you are considering an S corporation, you are not going to be taxed twice. You will be taxed only once. And this is actually great already. Boss, I want to quickly remind you of today's topic. We are having a conversation about S corporation distribution rules. Let me give you a few pro tips here. Let's first talk about taking money out of an S corporation. The owners of S corporations have options to take money out of the business. I mean, as any business, if you run a business and the business is profitable, then you would want to actually every now and then take some cash out, right? So let me give you the options here. First of all, if you have an S corporation, you can take money out of the company through wages. So any shareholder of an S corporation who works for the entity is considered an employee. Their tax treatment is the same as other employees who are not shareholders. This means what? It means that they receive a paycheck, withholding tax is accounted for, employment taxes are taken care of, and they receive a W-2 form. Pretty classical, right? A shareholder who works for the S corporation should actually expect to receive a reasonable compensation for the work he or she performs. And the IRS has pretty strict rules around the amount. They call it the reasonable salary. So the first option is wages. So you take money out of the company through wages. You can also take money out of the company through distribution from S corporation earnings. So a regular C corporation distributing its earnings out of retained earnings is considered a dividend. C corporation shareholders receive Form 1099 DIV, and they will in turn report the dividend on their individual federal tax return. S corporation in general do not make dividend distributions. They do make tax-free, non-dividend distributions unless the distribution exceeds the shareholder's stock basis. If that happens, the excess amount of the distribution is taxable as a long-term capital gain. And the thing is that distributions made by an S corporation are not subject to Social Security or Medicare taxes. The thing is that if you need help with S corporation shareholder distributions, you can actually just let us know in the comment section. We'll certainly get back to you. We'll certainly answer your question. Just be very specific: the state, the city you are routing from, and the sector you're in, and they will certainly answer you. Now, if you want more specifics about your case, just send us an email, and our team will delve into your scenario, and we'll get back to you. Not a problem. Let me give you a few facts here. Let's talk about S corporation distributions of cash and property to shareholders. And this is important because if you have an S corporation, if you have converted to an S corporation, at some point you might have to distribute cash and or property to shareholders. An S corporation generally passes through its income, deductions, losses, and other tax items to its shareholders, who then must include these items on their own returns, regardless of whether the S corporation distributes any income to them, right? This is really important. So it's not just the distribution of income that really is subject to a taxation here. Anything that an S corporation passes on to its owners, you have to actually reflect that in the respective tax forms. It's really important. And everything happens through Schedule K1. If you really think about it, Form 1120S, which is the form that an S corporation has to file with the IRS, that form is considered an informational form. In other words, you do not pay taxes at the corporate level, but you are informing the IRS of what's really happening within the company. The IRS is going to take that Form 1120S and reconcile the data on that Form 1120S with the data that all the individual shareholders would have filed on their Schedules K1 and Form 1040, as well as Schedule C. Okay, so it's really important. And what I want to say here is that it's also quite essential to remember that an S corporation may also make distributions to its shareholders in the form of cash or property. If the corporation distributes cash, the tax effect including the effect on the shareholders' basis in the stock, is based on the amount received. If property other than cash is distributed, the amount the shareholder uses as a distribution is the fair market value of the property. And so how S corporation distributions to a shareholder are handled for tax purposes depends on whether the S corporation has earnings and profits and whether the S corporation has a net loss for the year. Let me explain that. Generally, an S corporation has earnings and profits for a tax year only, if it was previously a C corporation. The earnings and profits generally represent C corporation earnings that were taxed to the corporation but were not distributed to the shareholders. A distribution from an S corporation that does not have any earnings and profits generally is a non-taxable return of the shareholders' basis in the corporate stock. However, and this is a big however, if the distribution is more than the shareholders' adjusted basis in the stock, what happens here is that the excess is taxable as a sale or exchange of property. And if the S corporation has earnings and profits, the distribution may be a taxable dividend, a non-taxable return of basis, or taxable as a sale of or exchange of property. So this is kind of important to remember that. Boss, I want to quickly remind you of today's topic. We are having a conversation about S corporation distribution rules. And one thing I want to say, I want to talk to you about how to determine the taxability of S corporation distributions. So as we are having a conversation about S corporation distributions, it's important to pinpoint the taxability of those distributions. An S corporation, unlike a C corporation, generally escapes income tax at the corporate level. We have already established that. Instead, its items of income, deduction, credit, etc. flow through to its shareholders, who then calculate and pay any tax due at the individual level through Schedules K1, Schedule C, and Form 1040. The treatment of an S corporation distribution depends on the shareholder's basis in his or her S corporation stock and the S corporation's earnings and profits and accumulated adjustment accounts, right? The TTAA account, the accumulated adjustment accounts. Then this could be a little complex if the S corporation was a C corporation before. Okay, so an S corporation will have an E&P only if it was previously a C corporation or it acquired the asset of a C corporation in a Section 381 transaction. An S corporation distribution from an E&P is treated as a dividend. It's really important to remember that. Now, the treatment of a distribution made by an S corporation without accumulated E&P depends only on the shareholders' basis in the S corporation stock. And so the thing is that every situation is different. What we can see here is that under Section 1368, an S corporation's distribution of cash or property may give rise to three possible tax consequences to the recipient shareholder. You have a tax-free reduction of the shareholder's basis in the corporation's stock, a taxable dividend, as I said before, or a gain from the sale of the stock, generally resulting in a capital gain. Now, these options are not mutually exclusive, okay? So this is really important to say that. And one thing I want to say here is that at the end of the day, you really want to do a little bit of research about because see, everything I'm telling you here, those are tax consequences at the federal level. You also need to account for tax consequences at the state level, because depending on the state where you're in, you might have complex or fairly straightforward fiscal implications here. It's always important, when in doubt, to contact a tax attorney, a CPA, or an enrolled agent, somebody who has who's really familiar with the nuances of the tax law, the Internal Revenue Code, and so that you can have the proper guidance that you need to sort of navigate the S Corp Distribution Rules. Now, when we talk about let's really try to understand the intent of the S corporation distribution rules. If you are, let's say, if you are the IRS or you are a state tax authority, you want to collect taxes, right? And if you are an entrepreneur, if you're a business owner, You want to pay your fair share of taxes. So regulators, legislators for that matter, at the federal level and at the state level, have tried to strike the perfect balance between those two models. And the thing is that, first of all, when we talk about S corporation, you need to understand that S corporation, you have a single taxation. C corporation, you have double taxation. The thing is that C corporation is more appealing based on a series of arrangements, is more appealing to investors. So a C corporation, if you have the intention of becoming a public company later on, of going public, of listing your shares on a stock exchange, it just makes sense from a regulatory perspective for you to be formed as a C corporation. But if you are planning to become private or run the business as a private business, or you have any other model in mind, it's just better to go with an S corporation. S corporation, if you choose the S corporation, the main purpose here is for you to have to be fiscally advantaged. In other words, to pay less taxes, to be taxed less. But paying less taxes doesn't mean that you are profitable or you are attracting the amount of capital you need to develop your business. So it's one of those things you have to pay attention to. So when we talk about from a federal point of view, double taxation, single taxation, less paperwork, more paperwork. However, S corporation, you are paying less taxes, but you are monitored. The IRS will pay attention to any paperwork that you file with the agency. An S corporation has I would say a longer list of items to take care of. You need to understand that all shareholders must be U.S. residents. This is an important element. They should not be above 100. So you have the threshold of 100 shareholders. So you have a series of regulations that you need to abide by if you want to remain an S corporation. And God forbid, if the IRS were to reclassify your S corporation as a C corporation or partnership, you would have to pay a lot of taxes. So long story short, if you choose an S corporation, make sure that you are aware of the rules and regulations that revolve around this legal structure or legal/tax structure. The thing is that I also want to close today's conversation by talking about something called the TTAA. So TTAA really is the accumulated adjustments account, and this is something that's really important for if you're an S corporation and you want to go, like if you're a C corporation or S corporation, and you want to navigate those two realms, those two legal structures. You want to think about the accumulated adjustment accounts. So the thing here is that you need to actually pay attention to that in terms of earnings and profits. Now, why do you want to do that? Because you want to maintain your S corporation status. Okay, if you do not have the proper sort of procedure in place when it comes to monitoring your AAA accounts, you might lose your S corporation status. And the IRS, as I said before, is paying attention a lot to how you handle things. So when we talk about general rules for taxation of S corporation distributions, you need to understand that the regulations differentiate between distributions made from an S corporation without accumulated E&P earnings and profits, and those made from an S corporation with accumulated earnings and profits. So the first step in determining the taxability of an S corporation's distributions is to identify whether the S corporation possesses accumulated E&P in the year of distribution. So as previously discussed here, an S corporation can possess accumulated E&P only if it was previously a C corporation or it acquired the asset of a C corporation in a Section 381 transaction. So an S corporation cannot possess E&P, earnings and profits, if it has never been a C corporation. In other words, it has been an S corporation since formation and has never acquired the asset of a C corporation in a Section 381 transaction. So determining whether the S corporation has accumulated E&P is critical. Why? If an S corporation does not have accumulated E&P, determining a distribution's taxability is a straightforward process. If an S corporation does have E&P at the time of a distribution, however, determining the taxability of that distribution becomes more complicated. Now, if you have questions around that, let us know, because it will be too long to explain here. And let us know in the comment section, and we'll certainly explain to you based on your situation how the whole thing will work, how you have to account for the taxability of your distribution. Every case is different, and we need to have a better idea about your situation before providing guidance. Thank you so much for your attention. I really appreciate it. I was just let me do a quick recap here. I was talking to you about S Corporation Distribution Rules. I was giving you the approach, the overview, the pro tips, and the facts. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.